Hello and welcome to Sectors Up Close. I'm Ramzan Karamali. Today we're focusing on US regional banks, and my guest is Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. It's fair to say that last week has been a tumultuous one for US regional banks. The demise of Silicon Valley Bank and then Signature Bank reverberated across the entire global financial system. Across both banks, several factors have been blamed for their liquidations. The rapid increase in interest rates leading to a decline in the value of fixed income investments, a mismatch in duration between deposits and investments, a lack of diversification across their client base, and a rapid decline in deposits have all been cited. The ultimate downfall for these banks, though, was triggered as customers rushed to get hold of their money. The vast majority of deposits at both were uninsured. The value of shares across the sector has plunged. The SBDR S&P Regional Banking ETF has lost over a third of its value over the past year, but most of those losses came within the last month. And the fear of contagion is still weighing heavy on investors' minds, despite interventions from the Federal Reserve, the Treasury and the Federal Deposit Insurance Corporation. Well, to help us analyse all of that and the collapse of those two banks, I'm joined by Randy Watts from O'Neill Global Advisors. Randy, thanks for joining us. I guess the most obvious question is the worst over for these small US regional banks?
I think on an individual basis, for some names, the worst is over, but there's still really tough sledding ahead. And that tough sledding ahead is really due to a couple of things. First is we are seeing a slowdown in economic growth here in the U.S. This is going to be exacerbated by what is clearly becoming a credit crunch in the banking sector. Net interest margins for regional banks have been shrinking as interest rates have been rising with the Fed. So I think that's going to be a hamper. And then clearly, this has caused enough concern in the American public that tighter regulation is coming for banks that have below $250 billion in assets.
Well, clearly these banks were hit hard by rate hikes, and we know the Fed aren't done with tightening. How do you see the sector coping with even more rate hikes?
Inflation is starting to slow in the U.S. CPI numbers this week were in line. PPI was actually light, so that's an encouraging sign. But I think you're right. The Fed is not totally done with its tightening cycle. The next meeting is on March 22nd. Right now, the Fed funds futures curve is forecasting about a 50-50% whether they increase or not. I think a likely outcome is a 25 basis point increase, but very dovish commentary and even a possible pause thereafter. As the Fed increases rates, it really has two effects on the banks. First, it continues to squeeze their net interest margin, what they have to pay for deposits versus what they loan the money out in. And as you mentioned, it also hurts the government securities that are on their balance sheets. Most of these have been bought over the last 3 or 4 years. As rates go up, the value of those go down. So that hurts both their holdings, and if they have to sell them, it hurts their equity.
Some in Washington have been quite quick to point the finger to changes to the Dodd-Frank and to governance, and said that the changes that were made under the Trump administration to make stricter regulations for banks under the value of $250 billion less important. I mean, how much do you blame on governance, and do you think there'll be a change here?
I do think there'll be a change there. What happened is they basically lowered the capital requirements for banks under 250. The idea was to help small and mid-cap banks be more competitive in the market, but it's turned out to actually have hurt them as they have less balance sheet stability. So I do think we are going to see regulation coming back to make that tighter. One of the net effects of this is a lot of assets right now are flowing out of these mid-cap banks, and they're actually flowing into those very big mega-cap banks like a JP Morgan, which have tighter capital requirements.
When you look at the regional banks in the US, do you think this sell-off has maybe been overdone a bit at the moment?
I think it's on an individual basis. You have to look at it on a bank-by-bank basis. But if you know, the other night, Moody's downgraded the entire U.S. Banking sector to negative credit watch. So I don't think we're through all of the crisis yet. It's possible in individual names we've seen the lows. But the fact is the Fed is not done with its tightening cycle. Demand for loans is probably going to drop. Margins are going to be squeezed. And as we've been talking about, regulation is coming. So that's not a really bullish outlook to load into financials here. I do think there'll be a time to do it. I don't think it's today.
If it's not today, then where should investors be looking? Should they be looking at bigger banks instead of these small regional banks instead?
I think if I had to invest in the financial sector, I do think I would be focusing on the very largest banks because I do think they're going to see a lot of these deposit runoffs come into their banks because of the stability factor. Essentially, these too big to fail banks are going to be the beneficiaries of the smaller banks being weak. So I think that is going to benefit people like a JP Morgan, like a Citibank, like a Bank of America. And I think we're going to see that in the numbers next quarter that their deposits have actually risen quite a bit.
Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. Many thanks for your time. And that is your look at US regional banks. I'm Ramzan Karamali, and this is Reuters.